We survived the month of September and actually finished the month in the positive territory, hitting a new record high. But now, as the tide beginning to shift, we have global tensions between the US and China are back. We have global shutdown headwinds. We have valuation headwinds. We have a weakening jobs economy, as well as rising inflation. Over the past year plus, this has been a resilient market that's been able to shake off things here and there as we continue to plow higher. However, when you look underneath the surface, it's really a lot of the Mag 7, the mega cap type companies that have been carrying the weight, especially of late. Do we need a crash? No. Am I looking for a recession? No. But are investors looking for a reset? Absolutely. And I believe that this reset is going to create opportunities in many stocks out there, and I want you to be ready. As such, in today's video, we're going to be focusing on 3 stocks that are high on my watch list. If each of these 3 stocks do in fact dip, and I'll be giving you my buy price targets for each of them and show you a few potential option plays as well, we're going to be adding these to the portfolio also. So make sure you stay tuned throughout the entirety of today's video, and if you find any value, I would greatly appreciate it if you just simply click that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And when it comes to investing, I talk a lot about the keys to building wealth. One of them is diversification, and that's diversification across your investments. But the other thing you need to think about as an investor is where you put your money. Diversification across various different investing platforms. And that brings us to today's sponsor, which is Moomoo, a platform that I utilize to not only invest in stocks, but also trade options. Moomoo is a one-stop global trading platform that is trusted by more than 26 million users across the globe. With Moomoo, you get access to a wide range of products and analytics, including individual stocks, ETFs, stock options, and yes, even cryptocurrencies. Many of their great tools you can utilize to review stocks. And if you're like me and love trading options, there's an options trading platform that is fantastic, and they give you the edge you need to make a profit. One of the key things I love is the fact that they have $0 commissions on both stocks and options. And the other thing, if you're new to Moomoo, you can create an account and grab yourself some free stock plus a cash reward. Right now, they're giving away up to $1,000 in NVIDIA shares, in addition to some cash giveaways. So again, just like we want to diversify our investments, also make sure you diversify where your invested capital is. Use various different brokerages the same way I do, and use Moomoo and grab yourself some free stock. Checking out that link down in the description below. All right, let's jump back into our video, take a look at 3 stocks high on my watch list, beginning with stock number 1, which is going to be Boeing, stock ticker BA. And again, Boeing is yet again flying high, but I think when you think about it from a long-term perspective, we're not even at cruising altitude yet. You see what I did there? Okay, all jokes aside here, this is a company that's been through a lot of turmoil. They've had Boeing accidents that have been out there. They've had doors, emergency doors, fly off mid-flight. It hasn't been all going right for Boeing for the past few years. However, the company has recently brought in new leadership, and things are starting to turn around for good. The company currently has a market cap of $168 billion. Over the past 3 years, shares are up 61%, and year to date, up a little over 20%. When it comes to Boeing, they've had to do a number on repairing their reputation with the public. But the thing to remember when it comes to Boeing is they operate in a duopoly with the likes of Airbus. And when you operate in a duopoly, you are a wide moat business. And I love investing in wide moat businesses. Looking here, you can see the company's growth in EPS. Dating back to 2024, EPS was actually negative at $19.57. This year, they will still be negative, but only $2.87. Next year, that all flips to the positive, as we are off to the races, growing 86% projected the following year. Remember, when it comes to investing, we don't focus as much on the past, we focus more on the future. It's less about what you did for me and more about what you're going to do for me. So looking ahead at the 2026 estimates, this has the stock trading at a forward PE multiple just a tad under 60 times. And with a growth rate of over 100% this next year and 80% the following year, you're paying a high multiple, but the growth more than backs that up, giving you a PEG ratio below 1. This is a stock that's still going to have plenty of turbulence, but looking out over the next 12 to 24 months, I believe the stock price in Boeing is going to be much higher. In terms of a buy price for me, I think that 207 level is going to be a key level to watch, followed by the $200 level. But ideally, if I could pick up shares around the 180 range, I would be a happy camper there. So I can wait on the drop, or this is a stock you could utilize options on. And for me, I want to be conservative here, given the greater market turbulence we're starting to see creep back into the markets. So I could sell the November 21st 180 put, generate around $200 in income per contract, which would require me to potentially have to buy 100 shares per contract at that 180 strike if shares were to fall. And that's going to lead us to stock number 2, which is going to be Merck, stock ticker MRK. And when it comes to Merck, they operate in the healthcare sector. And the healthcare sector has been a mess over the past 12 months. Looking here at this chart, you can see the sector performance within the S&P 500, which I filtered for the past 12-month performance. Healthcare, as you can see, the second worst performing sector, down roughly 5%. Meanwhile, the greater S&P 500 index is up over 17%. Healthcare is often viewed as a more defensive sector, but over the past 12 months, investors have been anything but defensive. When it comes to Merck, they currently have a market cap of $218 billion. Over the past 3 years, shares are down 5%, and year to date, down nearly 15%. As I've mentioned in past videos and within my Discord, The Stock Investor's Edge, Merck reminds me a lot of the same process that AbbVie went through. AbbVie had a #1 selling drug in Humira, which was its top selling drug, one of the best in the world, but they were very heavily reliant on that. They did a nice job of diversifying the business, growing the pipeline, and when Humira lost its patent protection, investors freaked out, but the company is now much, much higher than it was at that point. Now Merck has Keytruda, which is their top-selling drug, and they're going through the same thing, with patent expected to expire in 2028, but the company is building up its pipeline. It's already going through the struggles right now, but I believe it will come out stronger than they are today. Looking here at the EPS estimates, we can see that in 2026, analysts are looking for adjusted EPS of $9.60, which would equate to 7.5% growth next year and 9.4% growth the following year. This gives the stock a forward PE in the single digits at just 8.9 times and a PEG ratio of 1. Looking at low multiple stocks, that usually coincides with very slow growing companies in the low single digits. But when you're getting a stock at an 8.9 times multiple and shares are expected to grow around 8 to 9%, that's rather intriguing. The PEG ratio sitting right around 1. In terms of a buy price target, again, the current price isn't all that bad if you have no exposure, but $80 would be an ideal price target. The risk-reward setup seems very low at current levels. And that's going to lead us to stock number 3, which is going to be TOST, stock ticker TOST. And when it comes to TOST, again, this is going to be the smallest company of all 3 that we're going to look at today, but it's also going to come with the most risk attached to it as well. TOST is a cloud-based technology platform built for the restaurant industry. It offers an integrated suite of software and fintech tools to help restaurants run more efficiently. On the hardware side of things, TOST has POS terminals, kitchen display systems, handheld devices, and other hardware items. The company was founded in 2012 and IPO'd back in 2021. Currently, the company has a market cap of $22 billion. Over the past 3 years, shares are up over 100%, but year to date, down 5%. Again, this stock is still rather young, especially to the public markets. And when analysts are starting to get used to a particular company and investors are starting to get used to a company, it can come with varying parts of volatility attached to it. But for me, why the excitement in TOST? And whether we're talking about the restaurant industry or really any industry, management is always looking to become more efficient, especially in the restaurant industry. The company has big plans for expansion, and it has been expanding its installed base of restaurants, and in one quarter, it added over 7,000 net new locations. Now with that, when you think about a company that's connected to the restaurant industry, it obviously relies very heavily on the greater consumer and the greater economy. So if the economy was to falter, TOST is going to have added pressure. As you can see from this fiscal AI chart, TOST has had strong revenue growth, but more importantly, 2024 was the first year turning a profit from both an operating and net income perspective, which is quite impressive. Looking here, we can see that analysts are looking for EPS growth of $1.17 next year, giving the stock a forward PE of 29.9 times. EPS growth next year is 24%, followed by 26% the following year, so right around an average of 25%. This gives the stock a PEG ratio of 1.2, which is rather intriguing. Analysts are also upbeat on the stock with an average 12-month price target of $50 per share, implying more than 40% upside from current levels. And when looking at the charts, we have a stock with an RSI sitting right around 20, trading at the January lows, so this will be a key level to watch. And if it falters, I'll be looking to buy in the low $30 range, around $32 or so, which is only about 10% from here. But if you want to play it from an options standpoint, you could sell the $30 or even $32 put and generate between $100 or $160 per contract, which is actually a great premium given the stock price being in the low 30s. So there we just looked at three very different companies. You have Boeing, which is a mega industrial type company. You have Merck, which is a healthcare type company. And then you have TOST, which is kind of focused more on the restaurant consumer side of things. So there's something for everyone here. But in the comments down below, let me know which of these three stocks are you most upbeat on looking out over the next 12 to 24 months. Again, I hope you enjoyed this video. If you found any value, show your appreciation just by simply clicking that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.